Imagine you're driving on a long, winding road. The gas tank is almost empty, the warning light is flashing, and the nearest gas station is miles away. This is the metaphor that illustrates the current state of the U.S. economy, a situation more precarious than most realize. According to economic experts, the economy is running on fumes, with conditions that could signal an impending recession. But here's the thing. While a recession may sound alarming, it could also be your golden ticket to financial success, if you know how to navigate it. So, how do you prepare? Let's break it down. One of the most telling signs that we could be headed for rough economic times is the unemployment rate. After hitting a low of 3.5% in 2023, unemployment has started to climb, reaching 4.3% in July 2024, up from 4.1% the previous month. While some economists see this as a natural fluctuation, others warn that it could be a sign of deeper underlying issues within the economy. Unemployment isn't just a number, it's a powerful indicator of economic health. When people lose their jobs, they lose their income. And when income drops, so does spending. This decline in spending sets off a chain reaction throughout the economy. Less spending leads to reduced demand, which in turn slows down economic growth. To understand the bigger picture, we need to zoom out and look at the economy on a macro level. The lifeblood of any economy is its money supply. Without enough liquidity, money flowing through the economy, things start to stall. Recent data shows that the U.S. money supply is now lower than it was in July 2022, marking only the fourth time this has happened since the Federal Reserve was established in 1913. The last 3 times this occurred, the result was either a recession or, in the case of the 1929 to 1933 contraction, a Great Depression. So, what does this mean for us today? The shrinking money supply is a strong signal that the U.S. is on the brink of a recession, likely to hit late this year or early next year. It's a simple equation. Less money in circulation means less spending, which leads to less economic activity. When the economic engine starts sputtering, a recession becomes almost inevitable. But it's not just the money supply that's raising red flags. Inflation, another critical economic indicator, has also been a focus of concern. During the COVID-19 pandemic, when the money supply surged, inflation followed suit, climbing to a peak of 9.1% in June 2022, the highest level in over 4 decades. As the money supply began to contract, inflation started to cool off, dropping to 2.9% as of today. Experts predict that it could fall further to between 2.5% and 3% by the end of the year. This relationship between the money supply and inflation is rooted in the quantity theory of money, which suggests that changes in the money supply directly influence price levels, though with a time lag. What we're experiencing now is the delayed impact of the earlier contraction in the money supply. The economy is slowing, inflation is falling, and the risk of recession is growing. Now, let's take a look at the stock market, often seen as a barometer of economic health. At present, stock valuations are at historically high levels. According to Robert Shiller's cyclically adjusted price-to-earnings (CAPE) ratio, the current market valuation is about 35 times higher than the average over the past decade, one of the highest levels ever recorded. Only 3 times in history have valuations been higher: just before the 1929 crash, during the dot-com bubble, and right before the 2008 financial crisis. For those who prefer more traditional measures, forward price-to-earnings ratios also suggest that the market is overpriced, though not to the extremes seen in 2000 or late 2020. Additionally, the Fed model, which compares bond yields to stock yields, indicates that stocks are overvalued relative to bonds. In simple terms, the stock market is in a bubble, and when bubbles burst, the fallout can be severe. This brings us to a critical question. How should investors navigate this potentially treacherous landscape? Before we dive into that, if you're finding this video informative and helpful, make sure to hit that subscribe button and turn on notifications so you won't miss any of our future updates. Back to our discussion. For those looking to protect their wealth and maybe even come out ahead during an impending recession, one safe investment option is the 10-year U.S. government bond. When this bond was first recommended by financial experts, the yield was close to 5%. Today, it's dropped below 4%, meaning that investors who bought in early have not only enjoyed a solid yield, but have also seen significant capital gains as bond prices have risen. As inflation continues to decline, bond yields are expected to drop further, driving bond prices even higher. This makes the 10-year bond a secure option for those seeking both income and capital appreciation. When it comes to stocks, the outlook is more cautious. With valuations at such high levels and a potential recession on the horizon, it might be wise to avoid adding to stock positions for now. Instead, consider lightening your investment load and taking a page out of Warren Buffett's playbook. Buffett has been strategically reducing his stock holdings and accumulating cash, positioning himself to take advantage of future opportunities once the market stabilizes. Berkshire Hathaway, Buffett's company, now holds more treasury bills than the U.S. Federal Reserve, a clear signal that he's preparing for market turbulence. Following his lead, it might be a good idea to focus on liquidity, having cash on hand to seize opportunities when they arise, and investing in safe haven assets like treasury bills. Gold is another asset to consider. As a hedge against economic uncertainty, gold has long been a go-to for investors looking to protect their wealth. With the Federal Reserve likely to cut interest rates aggressively by 2025, the U.S. dollar could weaken, which would boost gold prices. Adding gold to your portfolio could provide a buffer against the economic storm and offer potential gains as the recession unfolds. In summary, while the economic outlook may seem bleak, it's essential to remain calm and strategic. Maintain your strong investments, consider shifting into safer assets like 10-year bonds or cash, and don't forget the protective power of gold. Like Buffett, be prepared for the potential storm, but don't panic. Instead, carefully adjust your investments to weather the possible downturn and position yourself for future success. If you found this video helpful, don't forget to like the video and subscribe to Economic Hero for more insightful content. Stay informed, stay prepared, and let's navigate these economic challenges together.